Good morning, everybody. Thank you for making time to be with us today. My name is Kyle Patterson. I'm from Bryson Insurance. We love to host these learning opportunities and webinars for our clients in the community. And today we are very grateful to be joined by Derek. He is the Vice President and Deputy Chief Economist for TD Bank. And Derek has joined us today to talk about the economic outlook for Canada. And we're going to do something really unique and different from the previous learning opportunities we've hosted, in that this is going to be a discussion, and instead of following a slide deck piece, Derek's actually going to share what he personally looks at and what he is looking at today. Derek also is aware that a lot of our clients are in the transportation industry, so he'll make sure to address that as well. But I really want to maximize the time we have with Derek. And so, Derek, I'm going to hand the floor over to you, and we can just jump into this conversation.
Yes, well, thanks very much. Pleasure to be with you today. I like this format. I get tired myself of just presenting slide decks all the time. There's just so much to cover. You find, invariably you got to add another slide on this, and then before you know it, you kind of talked for 45 or 50 minutes without taking a breath.
Yeah.
But I think the purpose here, we'll keep it tight. I thought I'd maybe speak for 10 or 15 minutes just to give you kind of the broad brush on some of the themes we're looking at, where we've been, where we think we're going in 2021 and beyond. We're learning about new indicators to kind of track things. I mean, now it's kind of shifted. At first, last year was all about mobility. As we looked at some of the data that was souring quickly, the question is, when would we stabilize? And one of the real-time indicators we latched onto were mobility trends. Now, kind of the mobility data of 2021 become more about vaccination rates and a lot of the health data that we tend to track. It's not only, I'm still looking at all my statistics on the economy, and I guess in a nutshell, I've been pleased at the resilience that we've seen in the economy, just given the fact the second wave of the infection in the US being the third wave through the fall into the early winter has been very, very challenging. And yet the economic data have been holding up better. So I guess just to start, 2020, we just finished. Canada, by the way, as an economy, kind of fared in the middle part of the advanced curve in terms of economic hit last year. The US didn't get hit as hard. Canada finished, so the US lost, I think, our estimate is about 3.5% GDP fell, that broad indicator of economic activity. Canada saw about a 5.5% loss. And a lot of the European economies, the advanced majors in Europe, lost 7-8% or even deeper, where the UK, I think, was down about 11%. So Canada was kind of in the middle, maybe a little bit more towards the US end of having got through 2020 with a little bit better than some, albeit we know it was a very challenging year overall. Some of the differences with the US, I would say, would be just the extent of restrictions in the US didn't quite equal Canada's level. So that was one of the differentiating factors, I think, to point out. Now, when I think of some of the other key themes for 2020, you've been hearing about the shape of recovery. As we hit the April lows, it was all about, okay, how quickly will we get back to a more normal level of overall economic activity? We were trying to fit letters into the sort of the characterization. Would it be a V-shaped, a U-shaped, which is kind of a slower grind? Would it be a W, where you get that deep recession, a bit of a bounce, and then followed by another deep contraction? I would say at the end of it, it was a lot of the letters kind of got thrown in the blender together. We had a much more V-shaped rebound than I would have thought, because we were quite pessimistic early on. So we saw a much bigger V-shaped snapback, and you can thank the good side of the economy for much of that, and just the shifts in spending towards goods-related, part of the economy. That was a big part of it. But then, since October, things did flatten out. And now as we start 2021, it becomes, okay, how's the economy going to fare in the early part? And with this view that we can get over the hump, we'll get back on a better track. But that K shape, I think, is an important letter to remember because, while V and U, there was a little bit of each within that, maybe V early on and then kind of more like a U of late. K was clear in pretty much everything we looked at, whether inequality between men and women in the workforce, between rich and the poor, but industries as well. And for those of you that are interested, we just put out a report yesterday that kind of ranked industries across Canada, 27 of them, based on performance since the pandemic started, which really was March as it hit ground in Canada. And then you've got your various performances, and it's very much a 2 or 3 track economy with some industries at the upper end that have just surged. And a lot of that has been, as mentioned, on the goods side, non-durable manufacturing in particular, more so than durables. I know in Canada, the auto sector has had some challenges that were kind of longer lasting. And then as well, at the bottom end, you had a lot of the high touch industries, the accommodation and food and the like. So nothing shocking, I think, but it really does, it's an important letter, I think, when we think back, whether VU, it's K that we remember. And I'll get to the outlook in a second, but, I think that's important. The other thing, just to point out before I look at 2021, is just the fact that government supports have really shaken things up. We've seen enormous spending by governments, nothing we've seen since the Second World War in Canada, add-on interest rates that have been pushed to zero, flooding the market with liquidity. It really has been a key factor that mitigated some of the downside, created the conditions for that early V, and even more recently, some better resilience in the data. Who would have thought that we'd be seeing interest rates at zero with no talk of any kind of increases for another 3 or 4 years? So astounding. So that's kind of, in a nutshell, some of the themes of where we are. I think more importantly, I think is probably where we're going to go in 2021. Right now, of course, we're tracking, some of the challenges on the vaccine front. I think one of the key changes we made in our December forecast, which, by the way, became a lot more optimistic about the near-term outlook, was we brought our vaccine assumption forward. We had this working assumption in our forecast that a vaccine wouldn't become widely available into the second half of 2021, perhaps more geared toward the fourth quarter. But then with all the developments and the results that made its way at the latter part of last year, we brought that assumption forward to the second quarter of 2021. Now, what do we mean by widely available? I think the assumption there is not herd immunity, that we wouldn't have 80% of shots delivered to Canadians and Americans by April or May of this year, but enough that a vaccine that would be rolled out that you could tackle the highest risk segments of your population, those in long-term care, the elderly and the like, and then you begin to kind of spread it out to the masses. That would lower risk, create a confidence rebound, and you'd have a big unleash of spend. And I think that's an important theme, is that households in particular are sitting on a lot of excess savings. I know it's not universally spread out across the population. A lot of higher income have been socking money aside, partly because they haven't been able to spend it, because a lot of the services have been shut, the holidays and the like. So that theme is still very much there. I think the question is, when will that be unlocked? And our December forecast had the beginning of that in the second quarter of 2021, after a weak starting point of the year. Now, a lot's happened since December. We've had a disappointing vaccine rollout to start. Are we highly discouraged? No, I think we always expected there to be kinks early on. That said, I mean, some of the vaccine nationalism in Europe is a concern, but we're still of the working assumption that things will pick up on that front. In terms of mutations of virus, this has been a risk all along. We know that vaccines tend to mutate. I guess the question is, how effective will the vaccine be against any mutation? And the jury's still out on that. I know there's some legitimate concerns with some of the recent variants out of South Africa and the like, that they may not be as effectively addressed through the current slate of vaccines. So there's still some risks, no doubt, around our assumptions. But, we're going to have to wait and see. A lot of continued research needs to be done on that. But we need to prepare ourselves that some of these issues are going to kind of push into 2022 and even beyond. But all that said, I think there's nothing thus far that makes us very worried that we can't see a pickup, as we kind of work our way through 2021. In terms of starting point, it's going to be a bit weaker, I think. But that said, I think the resilience of the data, we had some data out last week to suggest the momentum heading into the year was actually better than we expected. So a little bit of cross currents in terms of the risks. So that's kind of key. I think, one change we're making, and I know many of you deal on both sides of the border, even into Mexico, that our U.S. forecast is steadily climbing. So whereas Canada is still more optimistic than it was 6 months ago for the year ahead, we're around kind of 4.5% growth. The U.S. forecast has climbed even more sharply, partly because vaccines are flowing more freely. But I think the bigger thing is just a lot of government spending we're adding to our forecast. There was a $900 billion jolt through the holidays of spending that is beginning to get spent in terms of checks to the broader U.S. population. That's money that's going to flow and is already beginning to flow. And that led us to revise up our outlook for the U.S. And now you've got talk about another large stimulus package. So yes, it's going to create higher deficits, but it could give the U.S. a real push. So the U.S. forecast has gone from below Canada's, partly because they did better last year and they got less room to recover, but because of stimulus and the vaccine rollout success, I think there's a chance that it leaps above Canada's. So still pretty optimistic on both sides of the border. I think, it's something that, we'll have to wait and see, just tracking some of the vaccine rollout, but still feel comfortable there, as mentioned. Impacts of the new administration on Canada. I think one of the things that, there's been a lot of change we know already. Biden hasn't wasted a lot of time implementing a lot of executive orders. Keystone cancellation of the permit there. There's the Buy America, some of the provisions there. But the big thing, I think, and these are all things that I think as we kind of work through it, it's going to have more medium-term implications. Just quickly on Buy America, we prefer as a nation that, they wouldn't be implemented, but they're not new. And in fact, it's almost been par for the course, right? We did see some data the other day that in terms of Canadian involvement in government contracts, even during the Trump administration, I think the latest data were for 2015 or 16, it was about $700 million. So I'm not saying it's not important, but it's not like you're going from 80 billion of business down to, very little business. I think, again, this has been an ongoing challenge, and I know there's still hope that Biden will leave some room for exemptions with Canada, and that's still something we've got to get more clarity on. But many of these orders we need to get more clarity on. So not building them into the forecast. One thing I think Canada could get hit with more immediately would be higher bond yields because of the big amount of fiscal spending. It really going to, with the kind of growth outlook for the US, could put pressure on inflation, could drive up prices, and I think bond yields could respond. So you're looking at a rate outlook in Canada that still remains low compared to where we were 3-4 years ago, but we could see more movement at the longer end of the bond yield curve, even as the Bank of Canada sits tight, keeping short-term rates effectively where they are now through this year and next year. But bond yields could begin to climb in part because of just pressure in the US and a lot of the spending that could be viewed as inflationary. Now, are we in for hyperinflation? We're not in this kind of environment, but I still see the chance that inflation could surprise on the upside a bit, could lead to higher yields. And for a Canadian economy that is so, and you could argue for pretty much, apologies, let me just shut that off. It's really built on rates being low. A lot of debt, as you know, in the economy. We've heard a lot about household debt, corporate debt, government debt. Around the world, we're so, it's effectively been built on this notion that rates will stay close to zero for the medium to longer term. To the extent we see rates climbing up does pose a risk. And I think, before you could see hyperinflation, you could see rates moving down over the medium term because it just wouldn't be sustainable. But in the short run, it is a risk. We could see yields climbing. I know they're already off their lows. The other thing on the Canadian dollar, some of the Biden spending that they hope to get through Congress, and we have to wait and see how much of the latest Biden plan makes it through. It likely would be at least 800 billion, which is huge. That alone is about 6% of GDP. But in addition to what we've seen of late, that's a huge amount of stimulus. That could lead to a rebound in the US dollar in markets. And Canadian dollar, we had been in our December forecast pretty upbeat on the Canadian dollar. We had it averaging about 81 US cents in 2021. That may be prone to some downward revision. It's trading around 78 right now. So we might bring it down to a little bit below 80, because if the US growth, if we get a trillion, say, of new spending, that's even more growth than we have currently projected. We've got around 5.2 as our latest US forecast. Could be pushing that up a little further depending on how much spending. We'd probably pull our Canadian dollar assumption around. Now, not dramatically, but I think there's a downside risk to that prevailing view. I think that view of the 81 cent had been just due to the fact Canada, should do quite well this year relative to the US. But again, that advantage is eroded as the US has really ramped up fiscal spending. And I guess, I just end off with a couple comments on government deficits in general. The supports have been immense. We know Canada, the US, Europe, the spending, markets have been wide open to a lot of government borrowing. I guess the question is, how sustainable is this? And, it's not something that can be sustained at this rate forever. And, if it is, then you run into problems down the road where the markets at some point just decide they're not going to lend to you at a relatively low rate. The time is not now. I'm talking about over the next few years. You could hit a point where there are concerns. Governments plan to ratchet down the spending once the economies recover, but I do see the risks that deficits remain more persistent. And it's going to obviously lead to higher taxes at some point. I know the Biden plan has tax increases built in, not something he's going to address likely this year. That'd be more of a story for 2022. But I can see clearly some of the same trends in Canada. The US, if Biden pushes through higher corporate taxes, higher taxes on a higher income, it just allows for a Canadian government that probably will move down that path. So just, it's something that I wouldn't build into the forecast until it happens. But, that's another theme that clearly we're going to be mindful of. So, just a few thoughts. I don't want to just kind of, meander all over the place.
There's a number of questions that you've actually kind of addressed here and answered as well, just because you just spoke on the deficit there, and you kind of answered the question. And I think, there's a general belief or feeling that central banks have more levers and tools now to kind of manipulate what they need to manipulate to keep interest rates low. And when you look at sort of historical trends and historical evidence, right? So the question in here is really looking at, it's usually earmarked to credit risk, but it doesn't seem to be trending that way. Will it catch back up to that type of future where I even think, you're talking about long-term corporate debt, even more kind of, downgrading of credit risk for corporate entities, leading to higher rates too, but they don't seem to be trending that way today. So do you see, I guess the question here is, do you see that catching back up where the credit risk starts driving interest rates?
Yeah, I do see a risk of that. I think it's really been astounding how we call it an everything rally. That who would have thought this much risk in the economy? You've got a lot of businesses that are clearly not going to see the other end of the recovery. A lot of small businesses have been hit much harder than bigger businesses. We know the suspects. They're in retail and the like, and they've just so struggled with the restrictions. And yet insolvency rates are still very low. And we know that's just a temporary thing. Part of that is due to, deferrals and the like. And so some of that, I think 2021, we will see a lot of insolvencies pick up in general. I do worry. So even if central banks can keep rates low, and that's kind of key, I think that's really the dominant driver right now. They've got, as you mentioned, other tools. They're just flooding the market with purchases of corporate bonds and government bonds to keep yields quite low. What it's doing clearly is it's leading to more borrowing. And, maybe small businesses don't have a huge appetite to borrow. They take on a lot of debt already. It's more the corporates of the world. We saw more debt growth in Canada through the pandemic than virtually any other major economy. And I'm talking about all debt. I'm talking household debt has grown in part because of the housing market boom. Corporate debt has grown partly due to the design of a lot of these government programs that have, so this is by design, and corporate government debt obviously has surged. But Canada's seen more debt growth in aggregate, but also from a higher level. I mean, not so much government, it's been more a household story, to a lesser extent corporate. So I do worry about this from a medium-term perspective. Will it come back to bite us? It could very well. Hopefully, in an optimistic world, and it's just very hard to predict the timing of these events. One would hope that, and this was supposed to be a story for last year, that debt was supposed to cool off to allow incomes to catch up. Household in particular, they weren't going to borrow like mad. But we know the pandemic has thrown a wrench in that. That's delayed some of that. So a 5-year forecast would have debt growth remaining low, and incomes would be allowed to catch up. And what could help, lead to that would be yields are climbing in our forecast. As the economy recovers, yields go up. So naturally, you should get less credit demand. But we know things don't often work exactly according to forecasts. So just to answer, yeah, I do worry about that concern. I know I'm not alone in that, but it's not a new concern. That was with us before the pandemic. So, well,
and you talked before, because it gets me stuck. So one of the areas are, and it's related to some other questions that are in the chat there. So the K-shaped recovery, plus what we just physically see while we're driving around day to day right now is we see these big retail, plazas that are in lockdown, and nobody is buying anything, but we're turning to large entities to make all of our purchases. And there's some small businesses that are extremely resilient right now. But our economy is run in one part by natural resource. We're fortunate to have good natural resources, which have seen a decline in pricing in some of those natural resources. But then on the other side, we're so still driven by consumerism and the requirement of people that have to have, disposable money in their hands, so they can go out there, get a haircut, and then the hairdresser goes out there and buys a sandwich, and then that sub maker goes out there and buys that next thing, right? So I guess the question is, if that continues to slow down the velocity of money, or just that transfer of money, like what is the long-term impact of that, and how can just feeding more money into the economy solve that problem?
Yeah, I think it's a great question. Now, I guess the view is that some of that money will get spent. We have done estimates that suggest excess household savings right now because of the pandemic is like $200 billion. And so the way we've looked at it, what's been the savings through the pandemic relative to a normal cycle? And it's been very elevated. We know, I think I touched on this briefly before, but it's the moderate to higher income that have been saving, not necessarily the low income. So there is an inequality there, but still, one would expect that once we get over the hump and you can start traveling again, for example, a good chunk of that money will get spent. Not all of it will. I think surveys suggest that debt is, as mentioned, a concern. Some households will be sitting on higher precautionary savings. So this is not a near-term risk. This is a medium-term risk. And it comes back to what we've been warning for years. What happens if, stock markets all of a sudden really sour, or housing market's been a big part. We've seen wealth gains as well. And some of that could flow into spending going forward as well. People feel wealthier. Again, we know it's higher income in general. But, I think in the near term outlook, the spending outlook looks good. I just wish it was more balanced. The business investment outlook doesn't look great. Businesses are still very concerned. That's one difference with the US. We've seen investment trends really pick up. So we're still an economy in 2021 that's going to be driven by consumer spending, some paying down debt. What's going to kickstart our economy or drive it, in the next 3-4 years? That becomes more of a question. Hopefully some of the other areas will begin to step up. There's still some of the big questions. We know government spending won't be as big a driver either. So,
Well, yeah, it's hard to keep that up. A question in here because I know there's always advocacy groups advocating, but the question specifically is around the Bank of Canada soliciting from special interest groups, specifically sort of the unions. And I don't know more to speak to it except for um, I guess they're getting input from unions to help set direction. A, I guess, do you know anything about this? And B, do you have any commentary to it?
No, I don't. This is the Bank of Canada is getting
Yeah, that's just the question
advice.
that's in here,
Yeah,
and it's
I don't
something.
think so. I mean, our view is, they should be independent. They're, and they talk the game, they're setting interest rates to achieve a certain inflation outcome. And that inflation outcome, they would like to see more inflation, but there's that balance between allowing too much and allowing the economy to kind of reflate again. Same with the US Federal Reserve. And I think it seems reasonable. I mean, right now we're still depressed overall activity. We should see, a decent recovery this year and close some of the gap, but not all of it. I guess the question becomes, it's the worry with the Bank of Canada is more about the big deficit spending by the federal government and the fact that the Bank of Canada buying a lot of the government assets out on the market to try and keep yields low. Are they enabling big federal deficits? And we saw, you have to go back a number of decades that kind of dynamic can be inflationary, but really it comes down to the credibility of a central bank. For that to be really inflationary, you've got to have inflation expectations rise. And right now they're not. So that's an indicator I'm going to be watching. If all of a sudden households and businesses feel, the Bank of Canada really doesn't care about inflation. All they care about is making sure the federal government has, a good source of liquidity for their debt, and they're taking their eyes off the ball, then I'm going to raise my inflation expectation. That's going to get embedded in yields. We'll keep our eyes on that. I'm more concerned about a U.S. inflationary impulse and how that could ripple into Canada would be my primary near-term concern.
Great. And there's a few different people commenting around the real estate pricing. And I guess the curiosity there is the long-term trend of is it a trend, or is it something that's going to become more permanent of people moving out of cities, seeking more space, and thus, supply and demand actually is justified to see some of these increasing pricing we're seeing? Or is it sort of this fad that's going to, see a big drop in housing prices down the road, and people who think they have wealth sitting in their homes, it's not actual real wealth because the price will go back down. So I don't know, just your feelings about that.
Yeah, this is so great questions, and I have my crystal ball here, and it's a little bit muddy in spots, a little murky in spots, but I think a couple of questions we're dealing with is what will be a post-pandemic economy in Canada look like? Will we see some reversal? Right now, a key theme which is benefiting the housing market, at least outside of the downtown core, people leaving the smaller units in downtown Toronto or downtown Vancouver and moving further away where there's more space. I don't think that's a sustainable trend over the long run, in part because prices are getting bid up. There are going to be affordability constraints. And if we can get over the hump, and that's still our view, that the viciousness of this pandemic is going to subside. The vaccines will help, therapies, other tools. We're learning to live with it to some extent. And that will allow for government restrictions to be adopted going forward. And we will get to the other side. I'm not saying, COVID will be eradicated fully, but I think, usually the trend with these pandemics is that they become, more innocuous over time. And I think that's the hope with this COVID is that, in part because of the vaccine, there's a bit of a race here to get people vaccinated to reduce the risk. But we will get to that point, and hopefully by 2022, maybe 2023. But once you get that, you're going to get reversal. You're going to get people wanting to live downtown, people relocating, sending their employees downtown to these big office towers. Do we go back fully? No. You're going to end up somewhere in the middle, but you will get people moving downtown. And I've been looking at some of the condo sales. We had a huge rebound in December. Now, maybe at lower prices, prices are getting bid down. But clearly, as prices come down, they get more attractive to some. And if we can get over the worries of some of the vaccine, you will get takers. So my bet is no. You can't just get people flowing out. Now we'll still be left in a new equilibrium we saw that shift to urbanization. We've had suburbanization in the past. You're going to be somewhere in the middle. So you're not going to have that red hot demand for downtown smaller units as you did pre-virus, but certainly demand, just not that, drum tight markets and red hot demand. So that's our general take. General housing, it is that affordability constraint that's probably going to, curtail some upside in 2021. You can't have the kind of growth we've had. It's just not sustainable. At some point, affordability breaks it, and I think we're soon at that point. But that said, I'm always kind of talking out of both sides of my mouth. We did have a price forecast of a 10 or 15% decline. That was like 6 months ago. We thought the pandemic would really deal a blow to the housing market. We've removed that from the forecast. So we have a fairly flat trend. Home prices will grow, but pretty modestly in the year ahead compared to last year where they're up by double digits, which was, to me, one of the big shocks of 2020 was the strength of the housing market.
Absolutely. It's really held things up. And another, just as a small case, I was talking to a client yesterday who's in the printing industry, and, in 2020 hasn't actually seen that bad of a drop in revenue because of new opportunities that came up to print specific COVID related materials in grand scale. But that's a potential one-time type contracts that were coming through to create the inventory for these large enterprises. I guess the question here is, there was quite a bit of natural injections or natural new opportunities popping up for the resilient, agile business people. And looking out now into 2021, it's kind of like a lot of those things are already now in place. A lot of those structures are already here. We're still building more, but a lot of that work has been done. And if things keep going, I guess, the way they are, so this is under the scenario that we kind of have to stay in this type of environment more than being able to go back into stores in our free, normal way. What kind of, I guess, advice or outlook do you have for those businesses that are kind of sitting in the middle of that K, but they've been potentially they're now kind of being on that downward slope as they look out to their own future?
Yeah, and that's a great question. I think the report we had out yesterday kind of viewed that, again, we're not of the mind and our baseline, and we run downside risks, and that would be, to give an example, a much weaker economic outcome, which would affect our outlook right across the industry spectrum, would be that the virus continues to mutate in a way. Vaccines are ineffective. We go through third and fourth waves. We just can't get this thing under control anytime soon, and that could happen. I just think there's enough out there to suggest that we are on the better side of things, that, vaccines will roll out a little slow. They will get there. These companies can adjust their vaccines going forward to some of these variants that'll come up. And we're just adopting. We're learning to live with this. I think the big hit last year was partly because we just weren't prepared. We're learning to live with it, and businesses are. So that's our general view. And our K becomes less K-shaped. You get the bottom dwellers, like air travel is probably the worst. The numbers are astounding. Did you know that air travel was at 4% of their pre-virus levels at the peak of the crisis in April, just based on some of the data we get? And now I think they're up to about 15% of pre-virus levels, sort of the February levels. And we've got them maybe rebounding to 40% over the next year. That's still very low, incredibly low, but that is a huge growth impulse. And a lot of the bottom dwellers will see these heroic growth rates in our baseline, but off incredibly low levels. But it still is enough impetus for the overall economy to kind of keep that recovery well in place. The rapid growers, one would think that some of them would taper off. So you're still going to be at very high levels, like 150% of pre-virus levels, but a little bit of tapering. It's those middle dwellers, I think, that are very hard to guesstimate. And I think there's quite a variation between them. But, clearly some of them will really struggle, and some of them will lose ground. They're not necessarily the restaurants, some of these areas where you'd expect some of the spending to filter back into restaurants.
Sure.
Once we get into improve. So yeah, some of those dwellers we do worry a bit about. They're kind of going to be idling in kind of no man's land. But, some of them are like, even some of the areas of public administration, hard to think that area, but we do know that governments plan to cool some of their spending going forward. So some of it is government in that. But please look at the report. You probably don't have enough time here to do it a lot of.
Yeah, I'm going to ask you two. I'll ask you one because I want to ask you an opportunist question at the end here, so we bring it up. But on the other, just this other question about there's about unemployment in here. We're seeing that even with the airline industry, some announcements of additional layoffs, and other industries closing different retail locations. So we're seeing this like next wave of layoffs starting to hit now. And I guess the question is, I wouldn't say the question is necessarily about what's the unemployment rate projection and whatnot, but what's the impact of this widening gap to the unemployment sort of sector in general, not just people who are actively still filling that unemployment data, but those who have actually just pulled themselves out of seeking employment right now too, still collecting government support. And then I get the question is on the far side of that, what do you see coming? Because in manufacturing and whatnot, you've always known the long-term trend of technology, automation, slowly reducing the requirement for human resource, increasing technology. And now we're starting to see this in the service place too, in other industries where technology's not able to eliminate, because people like face-to-face human relationships. But what do you guys see in a long-term trend of employment opportunities coming out of this?
Yeah, it's a great question. And I think this is going to be a challenge for 2021. This is a legacy of the pandemic that just got accelerated. The whole automation, implementing some of these labor-saving technologies. And we've got the people that were hit the hardest by COVID, a lot of the ranks of the unemployed are the lower skilled right now. How do you then reskill them to meet some of the new jobs? Because they will be working with more computers and automation and the like. Some will get shut out of it. And they'll need to be reskilled, retooled for other type occupations. That takes time. So I think a lot of our growth outlook, we don't actually have employment moving tit for tat with the recovering economy. It underperforms, and we do have longer term scarring built into our unemployment rate to factor in some of the risks of displacement of the segment of the population that was probably are less tooled to deal with some of these changes. So it is a concern. I think it's going to be front and center in government policy, not just having CERB type payments, but unemployment that involves training. A lot of it is going to have to get funded. And this is something that, that the government, we heard from the speech from the throne federally, this is a kind of a key thing. So this will be big in the budget season in this year ahead, but it's very important. So it is a worry. And so this, so-called displacement. So there are going to be a lot of opportunities with kind of the shifts in the economy. We know that, but how do you then, match up the skills? And I think on the flip side, there's going to be more flexibility with hiring people in remote locations. So you're going to have a broader swath of opportunities to bring people in. There are going to be potentially tax implications and the like, and maybe tax policy has to kind of modernize to adopt with us. But yeah, a lot on the labor market that's going to change and be changed for the longer term because of the pandemic.
So final question, and we'll let you get on with your busy schedule. If you were to leave a message for small and medium enterprises, small business, bright spots, or what would you give them to kind of look out to be optimistic into 2021, to keep that energy under their wings, because they are hustling and they are working harder than they've ever worked before?
Yeah, I think it's unbelievable. How small businesses have been hit the hardest. I guess our baseline is not so pessimistic. We run these downside scenarios, but in general, I do think things will pick up. And there is a spending. And I know that people say, households, really? You think with all the debt and a lot of them have deferred mortgages and the like, how are they going to spend? But there's enough excess saving. And where will that saving be channeled? Are the people going to buy another workout piece of equipment, those that can afford it, when they've already got one? Are they going to spend some of that on the service side, the areas that have been hit the hardest? And I think that a good chunk of that money is going to flow in that direction. So, and it should be pretty soon. I think, here we are, February. I think, in the next 3-4 months, we're going to start to see the data firm up after soft start to the year and some of that money. So, I guess it's just more of the little bit of an optimistic undertone. Obviously not forgetting some of the challenges that will remain. So.
Absolutely. Well, thank you, Derek, so much for giving us your time today. Thank you, everybody, for all the wonderful questions. I know there's a couple people who are in this webinar who are actually, with TD as well, and I saw someone post the link to your report you were referencing there.
Thank you.
So we'll make sure that also gets emailed out to everybody. But outside of that, Derek, just again, thanks so much for your time, and thanks for being with us today. Take care, and all the best to you and to your family in 2021.
Great. It's been a pleasure.
Thank you.
Best
Bye-bye.
wishes. Thank you.